Well, welcome to all our High Rock clients and any other listeners on this rather windy and gray Tuesday afternoon in Toronto. And thanks for taking the time to tune in to our weekly webinar where we're going to talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategy. So sit back, relax, and perhaps grab a glass of wine. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. And this will be the final webinar for 2015. My apologies, I am a little nasally because I'm fighting a cold, so please bear with me. I'm Scott Tomlinson, and my partner and colleague, Paul Tepsich, the founder of High Rock, is not with us today as he has a previous arrangement. But our financial planner, Bianca Tomlinson, is on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we do invite you to feel free to ask questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, what's happened since our last webinar last Tuesday? And as we do each week, let's check into the top Google searches in Canada over the last week. Well, last Wednesday, the taxi cab drivers in Toronto protested Uber. And on Thursday, it was the Golden Globe nominations. Friday, the new Adam Sandler movie, The Ridiculous Six. And Saturday, it only took 13 seconds for Conor McGregor to knock out Jose Aldo to take the UFC title. On Sunday, the body of Cedrica Provencher was found after having been missing for 8 years. And yesterday, Google paid tribute to VKS Iyengar, who took yoga global back in the 1970s. Well, Google searchers continue to show no interest in financial markets, so once again, we are here to fill in what's happened since last Tuesday, to get a sense of what is yet to come and what we're doing with our models to get the best risk-adjusted returns for us and our clients. Once again, there is plenty to talk about. Well, let's start with bond markets. Well, it was a generally volatile week. Bond markets are actually ending up pretty much unchanged since last Tuesday, the exception being the U.S. high yield market, which is lower, but has certainly bounced back significantly since making new lows yesterday. There is still lots of volatility because of liquidity fears, which I will address a little later on in this webinar. Well, equity markets have been following the high yield markets, and volatility yesterday hit the highest level since the August and September period. Our benchmark world equity index is lower by about 1% since last Tuesday. At this time, China's Shanghai Composite is up about 1%. And the Japanese Nikkei 225 lost close to 5% on the week. Well, the all-country world index has been trending lower since last May as the global economic situation weakened. It made a couple of attempts to break out of that downtrend early in November and early in December, but could not gather enough buying momentum to do so. Last week, it broke down through the uptrend that had been in place since the August lows. Selling pressure accelerated on Friday last week following the sell-off in high-yield bond markets. Yesterday, buying support entered into the market at about the 55 level and continued through today up to and close to 56.20. Now, the market may want to test that downtrend line again at or about between 57.50 and 58 at that point. If selling emerges, again, the downtrend will be well established. However, if it does break to the upside, more buying may enter the market, and perhaps there just may be a Santa Claus rally after all. Much of it hinges on liquidity, and this we will see over the next couple of days as we get the Fed announcement tomorrow, and I'll talk about this more in just a moment. Well, oil prices have been a catalyst in the distress of the high-yield bond market, but since last Tuesday, oil prices have jumped. After making new lows yesterday, the recovery in oil prices has high yield markets breathing a little easier, and as a result, equity markets are also seeing buying. So in a nutshell, oil prices have been one of the catalysts that have been generally driving financial markets. Now, the Bloomberg Commodity Index has also been testing its multi-year lows. Well, with oil moving lower, the Canadian dollar hit new multi-year lows again. A client told me that their bank was charging Canadian $1.40 for one US dollar, which is the equivalent of 1 Canadian dollar equaling US dollar 71.5 cents. Tough for those snowbirds this year. Well, as I said earlier, the combination of lower oil prices and concerns about liquidity have pushed volatility back to levels not seen since the August to September period. Okay, well, the World Equity Index is comprised of about 52% of U.S. companies, so we keep a pretty close eye on what's happening in the U.S. economy. And we are pretty certain that the Fed will raise interest rates tomorrow following the end of its two-day meeting. That announcement will come at 2 p.m. What we are uncertain about is the impact on financial markets and ultimately the global economy. Now, there's plenty going on in financial markets at the moment, and volatility has reached levels, as I said, not since late summer. But some of this can be attributed to the uncertainty that is surrounding the Fed's decision and exactly what that would entail. What has the markets concerned is the amount of liquidity that the Fed will be draining from the monetary system in order to push rates higher, and what the immediate and medium-term impact will be on other credit markets. Now, tumbling oil prices have put severe pressure on the high-yield markets recently because a good portion of the high-yield debt is loans and bonds issued by energy and commodity companies. As liquidity dries up in these markets and investors are unable to sell these assets, it spills over into other more liquid markets. Now, if the Fed reduces liquidity, it makes it more difficult to sell assets because buyers will want better prices to protect themselves. And so those asset prices tumble, increasing the volatility further. These are short-term phenomena and technical in nature, especially in December when traders and investors are preparing for year-end, but they can potentially spill over to have longer-term consequences. Now, uncertainty here can force economic decisions to be postponed, and this aggravates an already struggling global economy. Well, last week we showed a series of charts that forecast further U.S. economic slowing. The trend in employment is lower. Manufacturing has been declining. Small business optimism has been declining. And the latest economic news on the consumer, the latest retail sales data that was reported last Friday, well, those data were somewhat mixed. Now, total retail sales are up only 1.4%, but the gain goes up to 3.6%, which is basically the core retail sales when you take out gas. Year-on-year rates show non-store retailers, otherwise known as online retailers, out in front at plus 7.3% to confirm acceleration for online sales. Restaurants are right behind at plus 6.5% year-on-year, followed by furniture and sporting goods, both at plus 5.4%. Altogether, core retail sales are up a moderate 3.6% year-on-year, held down by the contraction in electronics and appliance and soft readings for grocery store sales and general merchandise. Now, outside the core, motor vehicles are still in the thick of things at plus 4% year-over-year, with gasoline stations down about 20%. So total retail sales are up only 1.4%, but the gain goes up to 3.6% when excluding just gas, as I said before. Well, now for a little positive news, the GDP Now model forecast for real GDP growth, seasonally adjusted annual rate in the fourth quarter of 2015 was at 1.9% on December 11th. That's up from 1.5% on December 4th, and we showed you that last week. So a slight uptick there, forecasting a slightly better fourth quarter than originally had been thought. The forecast for fourth quarter real consumer spending as we just talked about, ticked up 2.2%, sorry, from 2.2% to 2.4% after the Friday retail sales report. The forecast for the contribution of inventory investment to fourth quarter real GDP growth increased from minus 0.6% to minus 0.4% after Wednesday's wholesale trade report. And this is somewhat better news for the U.S. economy. So again, we need to see a longer-term trend developing, but that could, in fact, be somewhat better than things had been anticipated for the U.S. economy going forward. Well, around the rest of the world, Euro area companies represent about 16% of the world equity index. Industrial output in the Eurozone was up 1.9% on a year-on-year basis in October, higher than a downwardly revised 1.3% rise in the previous month. On a monthly basis, industrial output grew 0.6% after falling in the previous 2 months, posting the best gain since July. The Japanese companies represent 8% of the world equity index. Industrial production in Japan rose 1.4% month-on-month in October of 2015, following a 1.1% growth in the previous month and matching market expectations. It is the highest growth since April due to an increase in shipments, while the inventories and inventory ratio declined. Year-on-year, industrial output has fallen 1.4% as compared to a 0.8% a month earlier. While companies in the UK represent 7% of the global equity index, and the Bank of England's Monetary Policy Committee voted last week by a majority of 8-1 to maintain the bank rate at 0.5% and unanimously to leave the stock of purchased assets, their version of quantitative easing, at its December 2015 meeting, as was widely expected. Now, policymakers have shown that there are concerns over what appears to be slower wage growth in the UK. Chinese companies represent 2.5% of the world equity index, and the latest data for industrial production in China increased a little over 0.5% in November and rose 6.2% year over year, accelerating from a 5.6% increase in the previous month and beating market expectations of another 5.6%. It is the fastest expansion since June, as all sectors grew. The manufacturing sector expanded by the most, followed by electricity, heat, gas and water production, and then mining. So generally, if we look at the global economic picture, there seems to be a slight bit of encouragement, and that may be something that will give the Federal Reserve a little bit of ease their conscience as they go to raise interest rates tomorrow. In Canada, where companies represent 3% of the world index, yesterday StatsCan released the national balance sheet and financial flow accounts for the third quarter of 2015. The value of household real estate grew, no surprise there, while the value of financial assets was generally unchanged. The household sector net worth rose 0.4% in the third quarter. On a per capita basis, household net worth was just a little under $260,000 per household, largely unchanged from the previous quarter. Non-financial assets, primarily real estate and consumer durables, rose 1.1%, while net financial assets declined by 0.6% as the value of financial liabilities increased more than financial assets. The ratio of financial assets to non-financial assets actually declined to 111% in the third quarter from 113%. Now, the value of financial assets was unchanged in the third quarter, following a 0.6% decline in the second quarter. Growth in both quarters was well off the 4.5% increase in the first quarter. The value of equities declined in the third quarter, notably listed shares as domestic stock markets, the TSX, was down, showed a decline of about 8%, and that continued to weaken. After weak growth in the first quarter, the stock of financial liabilities increased at a faster pace than the in the last 2 quarters, mainly as a result of rising mortgage liabilities. The ratio of total household debt to total assets edged up in the 3rd quarter to 17%. Since 2009, this ratio has been on a general downward trend, as you can see on the chart, as the growth in the value of assets has outpaced debt. Now, this ratio currently sits between the peak of 19.3% recorded in the 1st quarter of 2009 and the low of 13.8% in the 2nd quarter of 1997. Total household credit market debt, that's consumer credit and mortgage and non-mortgage loans, reached significant $1,900 billion at the end of the 3rd quarter, up 1.4% from the previous quarter. Consumer credit debt was $572 billion, mortgage debt at $1,200 billion. So leverage, as measured by household credit market debt to disposable income, excluding pension entitlements, rose to 163.7% in the 3rd quarter from 162.7% in the 2nd quarter. In other words, there was $1.64 in credit market debt for every dollar of disposable income, close to the record. Now, disposable income increased at a slower pace than household credit market debt. The household debt service ratio, measured as total obligated payments of principal and interest as a proportion of disposable income, adjusted to include interest paid, decreased to 13.6% in the 3rd quarter. The interest-only debt service ratio, defined as household mortgage and non-mortgage interest paid as a proportion of disposable income, reached a record low of 6.1%. So what does all that mean? Well, generally, Canadians have continued to grow their debt, and the ability to service that debt because of low interest rates is at historically the best levels ever. So it's not problematic as long as households can service their high debt levels. The growing value of assets has continued to justify the growth of debt. However, and what the Bank of Canada is most concerned with is that if asset prices start to fall from either a stock market correction or a housing market correction, or both, Canada's debt burdens could become more problematic if households are forced to sell assets to pay down debt. Now, if interest rates start to rise, debt servicing becomes more difficult, and this would certainly add to the problem. So that's why the Bank of Canada is as concerned about household debt levels as they are. So what do we see coming on the horizon? Well, bond markets do tend to lead other financial markets, so let's check in with the bond markets. Basically, they are little changed over the past week. Yield curves are a little flatter as short-term yields ticked up, and longer-term rates yields actually ticked lower. But the real story has been in the high-yield markets, and as they have a traditional impact on equity markets, the spillover has added considerable volatility to equity markets, as we saw earlier. And as we mentioned last week, high-yield bond defaults are rising. Historically, periods like this have been followed by a recession, something that we need to monitor closely. A liquidity problem could further exacerbate this issue. So we remain convinced, as we have been saying for a long time now, that equity markets continue to be expensive, although they have cheapened up a little bit since last Tuesday. For the 4th quarter of 2015, companies are expected to report year-over-year declines in both earnings at -4.4% and revenues at -3%. However, analysts do currently project earnings growth and revenue growth to return in 2016, starting in the 1st quarter. For the 1st quarter of 2016, analysts are currently predicting earnings growth of 1.7% and revenue growth of 2.9%. For all of 2015, analysts are projecting earnings of -0.5% and revenues of -3.3%, and revenues, yes, declining year over year. For all of 2016, so coming next year, analysts are projecting earnings of 7.9% and revenues of 4.4% as increases. Interestingly, last week, analysts were expecting revenue earnings to grow at 8.1. So already analysts are starting to downgrade 2016 earnings. Now, by the measure of price to earnings ratios, the 12-month PE is at 16.1, well above the average, the 10-year average of 14.2. Now, to us, this means that stocks at current prices remain expensive by this particular measure. As for the other metric that we like to look at, enterprise value to earnings, S&P 500 companies are valued at current market prices near 12.75 times, the 10-year average being just a little under 11 times. And as we often talk about, we don't really care much about anything, especially in our tactical growth model, that would be over 8.5 times. Margin debt, we monitor because we want to keep a handle on what investors and traders are borrowing to buy equities. It's another indicator of the health of the stock market. In 2007, margin borrowing turned lower and was followed by the S&P 500. So margin debt turned lower in May. That raises some warning flags for us. When the spread between large cap markets like the S&P 500 widen over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. As you can see from this chart, that is currently the case now, increasing the risk of a significant market correction. So what does it all mean? Well, tomorrow is Fed decision day, and I have been graciously asked to return to CNN's The Close with Michael Hainsworth, BNN's The Close with Michael Hainsworth at 4 p.m. The last time I was on, back in November, or on November 12th, I suggested that, among other things, oil prices would try to test lower levels, and that they have, that the Canadian dollar may well go to 70 cents. Well, it has not yet done that. But that the Fed would raise interest rates in December, and that I did not think there was going to be a Santa Claus rally. So tune in to see if I have to talk my way out of a tight situation or not tomorrow. By the way, the odds from a historic viewpoint do actually favor a Santa Claus rally because it is in most portfolio managers' best interest to see their portfolios close out the year on a positive note. So they tend to do a little extra buying as we get into the less liquid year end. It will be interesting to see if the expected liquidity constraints work against that this time around. Try to keep in mind that at High Rock we are less interested in short-term market moves and much more concerned with prudent long-term risk-adjusted returns in keeping with our disciplined investment process. But it is fun to test myself against the market, especially a market that is so volatile. Well, our discipline, as we often refer to, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. We are not alone in this thinking. Cash and cash equivalents are important defensive assets. We cannot stress this enough. So we are carrying greater amounts, greater than normal cash balances in our models and waiting for asset prices to get to more reasonable levels before we commit capital for the long term. Last week, in response to a listener's question, we addressed our models. These are our approximate current target weights for fixed income. The bulk of the model, 60%, is comprised of safe government and investment grade bonds. The balance is made up of a combination of preferred shares and high yield bonds. We reduced our holdings in preferred shares earlier this year as we suspected that banks' capital needs would bring an oversupply of new preferred share issuance. This resulted in a correction of over 20% in the preferred share index as supply outweighed demand and banks pushed dividend payouts higher to make them more attractive. In the global equity model, U.S. companies represent approximately 33%. International, that would be outside of North America, is just ever so slightly less than that, and approximately 22% of that right now, the target is cash. As you can see, we are overweight cash, underweight the more expensive U.S. equity market. And the third model is our tactical model, where we look for deep value in some small to medium-sized Canadian companies. We may own these companies only as long as they represent that value. If their prices suggest otherwise, we may quickly exit the position. That's the tactical nature of the portfolio. For example, earlier this year, we bought Air Canada for the tactical model, but after it returned about 15% over a couple of months, we decided that it was no longer of value and we took our profits. Now, a client portfolio will depend on their wealth forecast and their goals, their risk tolerance, and time horizon to determine what percent of each of these respective models they will have in their portfolio. For example, my portfolio would be 40% of the fixed income model, 50% of the global equity model, and 10% of the tactical equity model. Okay, so as we do each week, let's look a bit forward here and see what's coming as far as any economic news. So tomorrow we're going to see some euro area inflation and the U.S. November industrial production, as well as the most important U.S. Federal Open Market Committee interest rate decision. On Thursday, we're going to have retail sales from the U.K. for November, and then also on Thursday, the Bank of Japan will announce its interest rate decision. On Friday, we'll see what's going on with Canadian inflation for November. On Monday, euro area and UK December consumer confidence, and then the final revisions to US third quarter GDP. Now that's going to be a pretty dated number, so we're not going to pay so much attention to that, other than what the impact on that number will have for fourth quarter GDP. All right, well that's it for today's discussion. If anyone who is listening might have a question, please feel free to ask it now.
Hey Scott, I know that you mentioned that there's fewer companies that are kind of holding up the expensive stock, I guess, if you will, or the S&P, and then you said that margin debts increase. So both of those things sort of would, you would think, if you looked at both of those, that the market would probably go down, but then you say, you know, the forecasts for revenue and profit are, there's, I know they come down from what they're saying for 2016, but it's quite high compared to this year, right? So how do you, how do you predict?
Yeah, that's actually a great question. So what happens over the course of time is analysts will make their projections based on their economic indicators. Last year, at the beginning of the year, earnings projections were actually expected to be quite positive throughout 2015, but as we progressed over the course of the year, economic forecasts kept being lowered on a global scale, and at that time, all of the various things or inputs that go into the determination of what the expected or what the analysts expect for earnings get ratcheted down. So yeah, it's actually looking a little bit more positive. We are starting to see a little bit more positive economic news. However, these are well in advance, and as we have seen in the past, subject to a lot of potential revision. So
how reliable are their projections?
When we look at the forward price earnings ratio to price to earnings, so the chart I showed with 12 forward price to earnings is still quite significantly higher than the actual average over time. It was like 16.1, and that's looking forward 12 months versus the 10-year average of 14.2. So in essence, that tells us that the actual prices have more than built in that 8% growth in earnings going forward.
Well, I'm always puzzled by that PE chart that you have with the 14.2, because isn't it possible that history doesn't always repeat itself? Like, can't things become more expensive?
I'm going to flip back. Oh, absolutely. I'm going to just flip back to the chart, though, so bear with me, everybody, on the slide to go through. But as you can see, historically, we go through different periods of time. So we're looking back here to '05, for example. As we head into 2007, we see a similar situation where the forward expectations for earnings are driving share prices well above the S&P 500 average earnings. Okay, so
Right.
as we go into the 2008, 2009 period, everybody's examining those, and the values fall. And then as we hit the lows in 2009 and expectations start to rise again, stock prices actually lead. So expectations are better. But as we get into 2013, what is cheap, so that the fact that that green line is below the blue line makes stocks cheap and gives them value. Whereas once we see those S&P 500 prices move well ahead of actual earnings, that's where we start to see that expensive situation.
Okay, thank you.
So that's really what we're looking at in this particular metric. Now we look at a bunch of different metrics along the way, but again, we're trying to determine what makes sense, and we just look at this and say, well, we don't think that as these particular prices that we're seeing now make sense relative to what's projected as far as earnings are concerned.
Okay, thanks.
Oh, but anyway, I'm going to scroll quickly back to there and say that if anybody does have questions and wish to email us, we're more than happy for you to send them. We also love to get feedback on these webinars, what you think is good, what not, or what else see cover on these calls. But that is it for 2015. And as always, thank you for taking the time to tune in. We here at High Rock wish you and your families a wonderful holiday season and a happy, healthy, and prosperous new year. We will return with our next webinar on January 5th of 2016. So this is Scott Thompson signing off.